Hello and good evening, everybody.
Good evening, everybody. If you can hear us loud and clear, I guess if you can give us some comment below, that'd be great.
Yeah, I can just say yes on the comment section so that you can hear us clearly. Hi, Chin is in the house. Daniel too, Jatinder, welcome, guys. Thank you for joining us tonight. Jason, no, it's not changing house. It's just a different background. Hi, Samantha, welcome. Okay, thank you, Jason. Thought it was supposed to be Bull or BS. You guys love the Bull and BS session, right?
Yeah, it was my bad. I made a mistake actually on the timing. We'll definitely be doing that Bull and BS again, all right? Backed by popular demand.
Thank you, Fiona. Hi, Cynthia. Hi, Darren. Hi, Ting. Okay, thank you. Thank you, guys. So tonight, basically, is a session on CFDs. And in fact, this is just part of more sessions on CFDs. It's one of the instrument that we can use to take advantage of in terms of leverage. And of course, we all know that leverage is a double-edged sword, right? And that's the reason why we cannot just, do the whole CFD training in one day or 1 hour. It has to be divided into a few sessions. So, of course, our partner CIMB, CGS CIMB Futures is the one sponsoring this event. They are the one who actually bring this CFD. They are one of the brokers that brought CFD into Malaysia. And so we're going to take a look at what you can actually trade on the CFD platform. So it's quite a good platform if you want to give your money some steroids, right? Give it a little bit boost, right? And well, in CFD later you'll see we'll try to explain to you how it all works, right? And then to give you a feel of what to expect if you're trading CFDs, right? And because we are not only going to look at the local markets, in fact, CFDs, the local market is still not available yet on the CIMB platform, but it's coming soon. But there are other markets, like if you guys want to trade in the US markets, or even Shanghai, Hong Kong, not Shanghai, Hong Kong and US, this would be a fantastic platform to look at. And if also, you want to trade indices, you can as well. So we'll explain that all later on. All right.
I think those that attended the stock picking mastery program with me last weekend over 3 days, this would work really well with laddering, right? We talked a lot about laddering and we kind of went through the whole process. This would be a very interesting product for laddering, right? Okay.
All right. Also, so we have actually prepared a presentation slide for you guys to make it easier for you guys to understand. So if you have any questions at all during the presentation, you can ask those questions so that we'll try to answer before we move on. All right. So this is only a 1 hour session. We try to finish the presentation like in 40 minutes time and then allow you guys to ask more questions and we can chit chat more. All right. Okay. So let me just share my screen for a while. Okay, so first of all, I want to thank CGS CIMB for partnering with us, bringing this CFD trading mentorship for you guys, and it's open for everyone. But specifically, we have actually, the last session that we had, if you still remember, we actually had a recruitment drive for those who's going to participate in the CFD trading program. That means trading real money, where some of the money is going to be sponsored to your account for you to make use of. And we already selected about 20 of them, and hopefully you guys are here today to start this first session on CFDs. And we're going to have another 6 more sessions. Basically, we're going to dive deeper into how you could use CFD, right? And how to manage risk and what kind of tools you can use, whether it's for investing or whether it's for trading. And all of this is going to be covered in the next 6 sessions, right? So hopefully you guys can stay with us throughout this whole 6 sessions. We will only announce the next CFD session on our Facebook, or for those who are re-registered as the trading program participant. We will email to you guys or we'll contact you guys directly. All right. Okay, so Before we start, as usual, whatever that's being shared here today is for educational purposes only. It's not intended as any investment advice. So if you want to look for investment advice, please do look for a professional and licensed investment advisor. Okay, so what is a CFD, right? So in financial terms, basically it's called contract. So you're entering a contract, right? It's a contract for difference between two parties at an exchange. And at the close of the contract, the difference between the opening, which when you open a contract, it's not the opening price and the closing price of the stock, but it's when you open a contract. And when you open a contract, you can either go short or long. Okay, I'll explain that in a short while. Okay, so when you open a contract and then when you close the contract, then the difference in price between the opening of the contract and closing of the contract, that will determine whether you are able to profit or you're going to make a loss. Okay, that's why it's called contract for difference. You look at the difference. Of course, you look at the price, and then the value will be multiplied by the number of shares. For example, let's say you buy at $1, okay, and the price go up to 150, so you make $50, 50 cents per share. And if you bought, let's say, 10,000 shares, then you take 50 cents multiplied by 10,000. You're basically making how much is that? 50 times 10, 5,000 ringgit, right? So it's the value that you're trading. Okay, but the good thing about CFD, which I'm going to share with you later, is that like stocks, if you want to buy 100,000 ringgit worth of stocks, you have to fork out 100,000 ringgit. All right. So in CFD, you don't need to. Okay. So there are always two parties, right? In order for a contract to actually work. Same like stocks also, because if you want to buy, you need to have a seller as well, right? Okay. But in this case, it's a little bit different because when we want to go short, that means we expect price to go down. Short is like, you buy or you sell now and you buy back later, right? You sell first. Okay, and for us who are very familiar or used to trading stocks and we want to go short, it's like, I don't have any shares, how to go and sell first, right? How to go short. Now, this is a contract. That means anybody can open any contract, whether it's long or whether it's short. All right. So there are always two parties, whether you go long or whether you want to go short. So a person who long is basically a person who opens a position by buying a CFD, right? So this makes sense. This is like when you are buying shares, you can buy shares, right? But the short part it will be a little bit a little bit awkward for many people who are so used to buying shares, especially if you have not even traded futures market before, because in the futures market you can also go short, right? Because here you can actually say, when you go short, is a person actually opening a position by selling a CFD, right? Like I said, you don't need to own that share to actually start selling first. Okay, when you go short, so that's the additional part that you can actually make use of when we are trading a particular CFD. All right.
Actually,
Now,
just to add, if you want to go long position, if you think the stock price is going to go up, right? If you want to go short because you're expecting it to come down, right? So I guess from a value investing perspective, if you find a stock is undervalued or it's got good growth potential, then you would go into a long contract. Otherwise, if you think that it's way overpriced, right, then you may want to short it, right? So like I think last night, because Pfizer announced 90% success rate in a very small sample size of I think 94 participants, right? So what happened was that if you were to short, let's say a company like Zoom, so a lot of the COVID related stocks that benefited during COVID, like Zoom, right? The software Zoom, it went down, right? So if you have done a short and you say close the position, then you would have made money. Alternatively, if you have gone long on that, you would have lost money, right? So it kind of depends which position you are taking to of the stock specifically, and also your strategy, lah.
Yeah.
Yeah.
One of the other thing which we are actually going to share later on as well on our next session is, you can actually use this product to hedge a position as well, right? Like there are so many uncertainties. For example, in the weekend, and you bought, let's say, like you mentioned earlier, let's say you bought Zoom, lah, and because the announcement of this 90% success rate for COVID thing, and you get afraid a little bit, but you do not want to sell Zoom, right? you're still holding the physical shares, and you said, I'm just going to go short. Right? And the good thing about, again, CFD is if you buy 100,000 ringgit worth of Zoom, for example, right? Just an example, okay, you don't need to actually come out $100,000 again to actually go short on Zoom. All right, so this is where we're going to bring you next, which is the margin. All right. So there are many ways you can use these tools. Either you want to trade outright or you can hedge, right? And all of this is going to be taught in the coming sessions, right? Now, margin flexibility. Now, basically, margin is like putting a fit deposit, like a deposit, right? So, for example, right, if you want to buy 100,000 ringgit worth of stocks, you don't need to come up with 100,000 ringgit, right? These margins are basically set by the brokers. Okay, for example, if the broker give you a 5% margin, that means if you want to trade or buy something which is worth $100,000, you don't need to come out with $100,000. You only need to come out 5% of the $100,000. All right, that means you only need to come up with 5,000 ringgit. Okay, put it as a deposit, right? Like you go and put a 10% deposit in your property, right? Put a 10% put 5% in this case. Let's say I give you an example of 5%. You put 5,000 ringgit, but the value that you can actually buy, whether you want to go long or short, can be both ways, right? Is 100,000 ringgit. Okay, so that means your 5,000 ringgit has actually been multiplied 20 times. Okay, so that's what margin is all about. And we are probably more familiar with the futures market. Futures market has margins as well. Yeah, that's why they're all leverage products. So CFD is also a leverage product. Okay, but there are certain differences when it comes when you compare it with the futures market, and we're going to go through one by one. All right. So we are all familiar with stocks. So most of the comparison that we're going to make here is basically for stocks. Stocks doesn't have margin, right? It's outright. If you want to buy 100,000, you need to come at 100,000. But for CFDs, you have margin. Okay, so the margin differs in different products that you are trading. So later I'll give you an idea, and later I'll show you as well where you can get those information. All right. Okay, so how does margin works, right? So now, of course, first of all, okay, you need to open a CFD trading account. Okay, so CIMB Futures, CGS CIMB Futures is one of the broker that provides CFD trading. So you can actually open an account with them. If you already have a futures account, the futures account is only for futures. All right. If you are a CIMB customer and you have a stock trading account, that account can only be traded, can only be trading stocks. So if you're a client of CIMB, you still need to open a CFD trading account if you haven't have one. All right, it's a different account altogether. All right. So let's say, give you a simple example. You need to, of course, when you want to start trading, you need to put some money in, right? And let's say you put $10,000 in, whether it's in ringgit or whether it's in US dollar is entirely up to you. Okay, so let's say $10,000. So I already have $10,000 in my account. Okay, and let's say I want to buy a stock with a 5,000 ringgit value. Okay, it can be any stock lah. If the stock is $1, then you can buy 5,000 shares. If the stock is $2.50, you can buy 2,000 shares and so on. Right. So let's say you want to open a trade. You want to buy 5,000 ringgit worth of the stocks. Now, I have $10,000, right? Remember, I have $10,000. So I don't even need to come up with the $5,000 to buy that $5,000 worth of stocks, because all you need is, let's say, if the margin is 10% and 10% out of 5,000 ringgit is only 500 ringgit. Okay. So you have $10,000. Okay, you minus off $500. You actually still have 9,500. Sorry, this one is I have to change this figure here first. Yeah, you actually still have left to trade $9,500. Okay, so you only need to put a deposit which is called a margin of $500 to trade that particular stocks of value $5,000. Okay. So as long as you open the position, your $500 has to be maintained. Okay. Later we go and dive deeper into if you're gonna buy or you want to go long or short, there are some differences. Okay. And then of course this will be open, and the variation margin is basically based on whether you make profits or loss in real time, because the price fluctuates, right? So if you are long or short, depending on the direction of the market, that will determine your profits. Okay. So eventually, stage 4, when you close the position, the profits or loss will be returned together with your initial margin back to your account. All right, so you just basically get back whether it's profit or loss. If it's loss, then you have to minus it off. Okay, and this is calculated normally in real-time basis, because it is when you're trading this platform, it's on a it's like market, like you're trading shares, is moving real time, it's moving every single second, right? So this is being calculated on a real-time basis. So you can see your account. If you have an account, you can see your profit or loss real time. Okay, so that's how margin works. Okay, so I'm going to go later give you more details on how it looks like.
Is anyone lost at this point? I mean, just curious, right? Actually, the concept is very similar to if you have a housing loan, it's exactly the same thing, right? If you put down 10% and you borrow 90%, it's exactly the same kind of concept. Yeah. So if you put down 20% in your home to buy a property, you borrow 80%. It's exactly the same thing, right? So kind of not to be confused, is basically you put a deposit and the rest is basically on leverage. So it's exactly the same as how you would do it for your mortgage as well. It's the same, almost the same, 80-90% same. But you're doing it for stocks instead, yeah. Sorry.
Yeah, so you actually get more excitement, basically, right? Because property prices don't move up that much every day, but stocks do move a lot. So that margin, that like Alvin mentioned earlier, right? That finance part can actually be quite a lot, right? Because stocks can move 10% or 20% a day, and not properties, lah.
Yeah.
Okay. So stage 4 is basically closing a position. Your profit and loss will be returned. So now your value will be returned back, depending on how much lah. Okay, I'm gonna go on next one. Now the next difference between CFD and stocks is basically long and short positions, right? So remember, there are two. You can have two views. Okay, either you want to go long, that means you're expecting price to go up and profit when it goes up, and of course you want to go short when you expect the price to go down. All right, so this is where it's interesting, right? Because in the stock market, of course, Malaysian stock market you can only make money one way, right? Which is when the price goes up. Okay, when the price goes down, you can't make profits, all right? Unless you short the futures market. So CFD allows you to do that. You can actually short if you think that the price is really quite high, and you think that it's going to come down even for a correction. You can go short and you can make money when the price comes down. Okay, so this is quite straightforward, yeah. So this is the additional feature that you can get in CFD as compared to stocks. Now, next one, for corporate actions. Now, when you buy a CFD, you don't actually own that particular stock. You own that contract, all right? But that contract gives you most of the benefits that a stock has as well, okay, including dividends, all right? So whether there's an adjustment, whether there's a split or bonus and so on, all of this will be reflected on your CFD prices as well. Okay, all will be adjusted as well. So it's the same like buying a stock. The only difference, of course, is because you don't really own that stock, you don't have a voting rights. Okay, that's only you can't say that, I have let's say a Maybank CFD, right? You can't go to GM, you can't go to the AGM and say that I own your shares, all right? Because you only own a contract to have those Maybank shares. Okay, so the only thing is that you don't have that voting right, you're not really a shareholder. Okay. Now the fourth part, right, in CFD trading is the transparency in pricing. Now, of course, when we trade in Bursa Malaysia, it's also transparent, right? Because you are trading directly through the exchange. Okay, but there are many different kind of CFDs right now in Malaysia, right? And a lot of them are not even incorporated in Malaysia. Most of them are basically in overseas, and worst of all, most of them are in all those what you call offshore countries, right? Like British Virgin Islands and Cyprus and so on, where it's not regulated. Okay, there are two kinds of markets actually that CFD provide. One is called a direct market access. Okay, a direct market access basically gives you the same transparency like you are buying any shares in Bursa Malaysia. Okay, whatever price that you see on Bursa Malaysia, quoted on Bursa Malaysia, that's what you're going to get. All right. So same thing when you're trading CFD, a regulated one. All right. Like for example, through CIMB, CGS CIMB futures, is that you actually get a direct market access. Okay. The other system, okay, is called a market maker model. Okay, this is where most of the unregulated CFD providers provide. Okay, they may not. If you look at these market makers, right, some of these market maker CFD providers, you'll see that their price that they quote on their system, okay, may not be the same as the exchange. Okay, because they set the price. Okay, so of course sometimes they can actually set the price to their own benefit, lah, right? Because they will, once you go to the system, they know what price you buy, what price you sell, and where you put your stop losses, where you put your profits, and so on and so forth, right? So you may not have an advantage, but in a direct market access model, it's basically is a level playing field, right? It's basically like just buying a stock in Bursa Malaysia. Okay, so the DMA CFD, no additional spreads, because some of the market maker model, they will have that spread. They add one or two more difference in buy and sell prices because they also want to make money from the spread. Okay, but for CFD, whatever that you see, for example, if you're trading Tesla, right, on the New York Stock Exchange, if you see the buy and sell price, okay, and when you see this price on your screen, on your trading screen, on the CFD model, DMA model, you get exactly the same, right? Exactly the same with what is quoted on the New York Stock Exchange or any exchange that you're trading. All right. So it's a straight through processing.
Add a little bit, because I used to trade quite a bit of CFDs. More than 10 years ago, and one of the early things was I go and compare, which one has the lowest brokerage rate. Okay, now just to share you don't go for all that free, unregulated, very cheap brokerage rate, because you're gonna end up paying somehow. Okay, and that's the huge difference between DMA and actually market maker, right? Some can also charge you zero brokerage, so you say, oh, fantastic, right? Then you kind of put in all your data there, and you put in your money as well, right? So I mean, this is true, right? I think this is quite an open secret, right? So on the market maker model, essentially, you think of it like a casino. You're betting against the house. And for some of these CFD providers to make money, the house will always have to win, right? So this is where it gets. So there are plenty of CFD or forex kind of providers out there. They don't use this model, and a lot of them are not. Well, they claim to be somewhat regulated, lah. Okay. I would to say unregulated, maybe I won't be 100%. Like, could be regulated in another country that you may not have heard of, right? But I think that's really what sets the difference. So one will have like very cheap fees and everything else. And let's say you compare, let's say against this CIMB CGS one, CIMB CGS is transparent. So literally everything is upfront, right? So that they know. Very scary is when you go there and you don't know how they make money. Okay, that's the scary part. Okay, you don't know how they make money, then they're making money from you and you don't even know. Okay, in this case, it's actually quite clear where their profits lie. Yeah, that's right.
Yeah. All right, so it's important to know whether you are trading. That's why we also want to mention this to you, because it's like Alvin said, there's a huge difference between DMA and a market maker model. So make sure it's a direct market access model. All right. Now, next one, number 5 is the difference. Of course, if you're comparing with warrants, for example, because a lot of stock investors and traders, they normally use warrants as one of the leverage product for a particular share, because basically the price is cheap, right? It's much lower than the mother share price. But of course, warrants has expiry, and but if you're trading CFDs, there's no expiry. Okay, you actually have a freedom to roll over your position on a daily basis until you choose to close the position, of course, or until the stock goes bust, right? But there's no expiry, right? Unlike the futures market as well, futures market contracts has expiry dates as well. So no matter if you want to hold, when it expires, you still have to sell it automatically. You have to sell or close your positions, all right? But this is different. CFD is different. You can continue to hold your position. And that's the reason why Alvin mentioned earlier, you can actually use this also for investing, all right? But of course, when we go into a leverage product, or when we put in a 10% margin or deposit where you get more money to actually invest in, there are some finance charges. All right, there are some finance charges. So they call it the CFD overnight financing. That means this financing is only charged if you do not close your position before the market close. All right, the moment the market close and you're still holding that share, you're going to be charged with a financing fee. Okay, if you buy and sell within the same day, then you're not going to be charged. Only if you hold it overnight. Okay, so what's the overnight financing like? Okay, maybe later I'll show you examples. So this is a financing that is going to be charged by, of course, the broker to you guys for lending you those extra shares, right? Lending you that extra money for you to boost your deposit that you put in. Okay, so the calculation here is basically the position, the quantity, which is your how many shares you hold. You multiply it by the price, then you get basically the value. Okay, mark to market, you won't calculate the price. For example, you buy at 1 ringgit and then at the end you sell at 150 for 5 days. That means you're going to calculate 5 days interest based on that last value. Now this is mark to market. That means the interest is going to be charged on a daily basis. All right. So you take the position quantity, multiply by the price at the end of the day, okay, which is mark to market. You multiply by the effective rate. This is the rate that they are charging. All right, effective rate, multiply, and of course prorated by the number of days that you actually hold over a year lah. All right, over a year. So if you're holding for 5 days, then you multiply by 5, divide by 365. If it's on a daily basis, that means you just divide by 365. Okay. Now there is a difference. This is where the difference comes in. Okay, between financing for long positions and short positions. Okay, long positions, basically. Oh, I think I got this thing wrong. Okay, long positions is the financing rate. Okay, plus the base rate.
Yep. So think of it like a home loan, you got a BLR or BR, right? Plus something. So it's very much similar. Yeah.
Yeah. So this one is we call it the financing rate. This is a financing spread applied by the broker, and of course the base rate is based on the interbank rates. All right. Like for example, Malaysia, I think KL1 we use CLIBOR, right?
Yeah, CLIBOR. Yeah.
The CLIBOR rates. Okay, so the thing is that if the interest rates are high, your financing costs are higher lah. If the interest rate is low, then your financing cost is lower as well. Okay, that's for long position. That is if you buy shares. Okay, but for short positions, it's the other way around. Okay, short positions, if the interest rate is low, your cost will be higher. Okay, if the interest rate or the base rate gets higher, your short position financing rate is lower. Okay, so it's the financing rate minus BR. So BR is basically the base rate. Finance rate is basically the in-house or the broker or the institution rate that they charge lah. All right. Now this is also it's calculate the interest is calculated on a daily basis. So the moment you hold your position and the market is really close, you will be charged. Okay, so from Monday until Thursday is considered 1 day. But let's say if you buy a position on Friday, you open a position on Friday and you decided to hold and the market closed on Friday, you're not going to be charged for 1 day, you're going to be charged for 3 days. All right, because it's Saturday and Sunday included. Okay, so that's the only difference. Okay, days for a year, okay, is 360 days. They calculate 360 days in a year if the contracts are settled in US dollar. Okay, if it's not in US dollar, other than that, it's going to be 365 days. So just to give you an example, right? Let's say you go and long. Remember, you're going to buy, right? Long means you can buy on 1,000 XYZ CFD. You buy a company called XYZ with a mark-to-market price of $10 from day 1 to day 2. That means you hold it, you buy today, you only sell it tomorrow. All right. So let's say okay, the base rate, and of course this is not the current base rate. Okay, just now I've just talked with Alvin. Actually, the base rate and the finance rate has gone lower. Right? Maybe after Alvin will share with you what's the base rate and finance rate. So assuming right now, let's say the base rate is 0.98%. All right, and I'm talking about US, right? Of course, our Malaysian base rate is higher.
Higher.
Okay, but the US, of course, US is very low. So let's say the base rate is 0.98, and in fact today is even lower lah. Okay, and the finance rate is 4%. So the effective rate, you add them both because you are long, right? So you add those both of those rates, so you get 4.98%. Okay, so that will be your cost. That means that if you can, let's say, even get if your stock perform more than 5% a year, you already cover this lah. And 5% a year is not much for CFDs when you look at the calculations we're about to show you later. All right. So N is basically the number of days. So we calculate on a daily basis. So we're going to put 1, and we're going to use the 360 days because let's say this is a US stocks. Okay, so based on the 1,000 shares that you're trading and is $10 in price. Okay, so the value is actually 10 times 1,000. So the interest rate is going to be calculated on the value, which is $10,000. Right, so $10,000 multiplied by 4.98%, and you multiply by 1, which is the day that you're calculating the interest, divide by 360 per year. So you calculate this, you get $1.38 a day. So that's the interest rate you'll be charging. You'll be charged. Okay, and this interest rate will be charged on a daily basis, and it will be reflected into your account. All right. Okay, short financing. So short is cheaper because you take the finance rate, okay, you minus the base rate. In this case, 4 minus 0.98, then the interest rate, the effective rate is only 3.02%. Okay, so let's say we do the same calculation here. Instead of paying earlier 138, okay, for a long financing, you only pay 83 cents for a short financing. Okay, so now imagine if so there's a time I still remember when you actually get interest by going short, right? And that's when the base rate goes high lah. For example, let's say the finance rate is currently 4%, right? And the base rate, for example, right now has gone up to, let's say, 5%. So if you take 4% minus 5, you actually get a minus 1. That means the bank is going to pay you 1% a year, okay, for going short. Okay, if that happens lah. Okay, but right now it's all low, right? That's why both sides also being charged. Okay, so that's for the overnight financing for both long and short positions. If you guys have any questions, you can ask those questions, right? And then we'll try to answer them if we see if there are any questions that need to be answered immediately. If not, we'll answer this after the presentation. Right. So what can I trade? Now, different brokers, of course, provide different products that you can trade. So here, because we're talking about CGS, CIMB. So if you are trading through CGS, CIMB futures, you basically can trade 2 products, right? Stocks and the index. Okay, I'm talking about a cash index, not the futures index. Okay, so if you are, if you always look at the Dow Jones Industrial Average, or the S&P, and you are very good at predicting indices, then this could be a good product for you, right? Because there are a lot of people who are very good at predicting indices, right? Instead of looking at individual stocks, right? So if you have a view, if it's going to go up, then you go long on the index. If you have a view that's going to come down, then you go short on the index. Okay. And of course, if you look at the whole market, there are many other products that you can trade. I mean, as long as there's a commodity like gold, silver or whatsoever, you actually have CFDs for this. Okay, but because these are all regulated, and for now we have these right? We have stocks, and if you are trading through CGS, CIMB, you are able to trade US stocks, China stocks, Australian stocks, Hong Kong stocks, and also Singapore stocks. Not Malaysian stocks yet, but from what I heard, they said that it's going to be one of the products going to come soon. All right. So cash index, this is just some examples, right? There are other indices they can also trade. Okay, the Dow, you can trade the S&P, you can trade the Nasdaq, you can trade the Nikkei 225, the Straits Times Index in Singapore, the Hang Seng Index in Hong Kong, and so on and so forth. Most of the major indices are there. All right. And for every product, okay, the margin, remember we talked about the first part, talk about margin, the margin is different. Okay. Now, how do I get the list of stocks that you can trade? Okay, what you can do is you can actually go to CGS CIMB website. Okay, it's called iTrade CIMB. Let me just share the screen.
Yeah, Benny, what I'll do is I'll try and share it in the link below. I think there were some questions here, so Yeah.
The link to iTrade, is it? Yeah. Okay. Yeah. Alvin has just shared the link, so you can click on that link. You immediately go there.
No, yeah, that was for the individual ones. Let me try and see whether I can find the link. Hang on, give me a minute. Yeah, but you go ahead. You go ahead.
Yeah. So if you go to iTrade CIMB website, and of course in CGS CIMB you have all the stocks and futures and so on and so forth, right? So once you get here, you go to products and services, okay, and then you click the last one here that says contracts for difference. Okay, so you click here, and this is where you're gonna get most of the info for CFDs, okay, through CIMB. Okay, I just this thing is still loading. You have to wait for a while. Okay, once you have this, you can go to who is CGS. Of course, you want to go about understanding CFDs. You can also click this, and in fact, we actually had someone from CGS CIMB Futures when we started our campaign 2 weeks ago, right? They already talked about this, so you can also get his slides over here. Okay, so you can actually go to our products. Okay, you click on the menu here, our products, and then here you'll be able to see you can trade equity markets, right? The time where you can trade and so on for each market. And of course, if you want to list, for example, let's say I want to look at a US one, just click on the US list, and then you will you'll actually get a PDF. All right. Let me just now because it opens another one. Let me see whether they show this or not. Okay. Yeah. So these are basically the list of US stocks, including both NYSE, New York Stock Exchange, and also Nasdaq, lah. Right? And then they will also show you, and this list will keep on be updated, right? And of course, whenever there's an update whatsoever, it will also be reflected onto the trading platform, lah. Okay, so you'll be given a trading platform where you can trade the CFDs. So you can see here, for example, this sorted by alphabetical order, I think. So we have Alibaba Group, for example, that's the code. Okay, when you type into your trading platform, that's a code you can type in to search for this counter. The margin rate here, it says 20%, right? If you look at American Express, the second one, for example, let me see whether I can zoom this.
Benny, you want to zoom in? Yeah, zoom in a little bit.
Okay, so if you look at, for example, Alibaba is 20%. Okay.
I think zoom out a little. Just zoom out one more time. Yeah. Yes, perfect.
Okay. Yeah. So you have Alibaba, for example, 20%, and then you have American Express 10%, Apple 10%. So the lower the margin, that means the less money that you need to deposit or put in the margin to trade the counters. So 10% basically gives you 10 times leverage, right? $100,000, but you only need to put in $1,000. Okay. If it's 20%, you get a 5 times leverage, because if it's $100,000 that you want to trade, okay, or buy or sell, okay, you only need 2,000 ringgit, $2,000. Okay, that's 20% of the 100,000. Okay, so it depends. Normally it's 10 to 20%, but of course some of the counters that probably is unknown of, not much trading volume. You need to put 100% volume, but generally it's 10%. For index counters, okay, that's what I got from CIMB. Okay, if the counter is inside an index, whether it's Nasdaq or the S&P, right, then they are 10%. If they are not in the index, it's normally 20%. Okay, so this is just NYSE, right? So this one has how many counters here?
Quite a lot, I think. Quite a lot.
Just gonna
I mean, just to give you guys
down.
an idea, I think Amazon is like $3,000 or more for one stock.
One stock.
So I think in the US market, if you kind of look at the big brands that we kind of don't get here, I think this is quite good exposure. You are actually how do I say? You can buy minimum one share. So you don't have to buy so many shares, like you don't have to buy minimum 100 lot size. So the lot size is 100. And I think for investors, the beauty of it is you also get the dividends as well. So if your margin rate is, let's say, 3 or 4%, and you get a 3 or 4% dividend yield, essentially when you do this margin, you are essentially negating to 5 stocks that pay you dividends. Actually, will negate the cost of your financing as well, right? And looking at where we are today, financing rates are super low, right? I think if you look at the overnight US dollar, it's I think 0.15%, right? So I think you add up all of CIB's fees as well, you're still paying less than 4%, right?
Less than 4, yeah.
Yeah, less than 4, right? So I guess if you're going long and you're holding these stocks long term in a very low interest rate environment, and then you say you're only putting down 10% or 20% for a big cap like Apple and things like that, your returns could be. I think Benny will share the returns later, kind of give you an idea how it works. But I think what part of our mentoring session is so that we kind of give you guys different ways to kind of set up your trades. Today is really just very, very intro to get you guys started. Yeah.
Yep. Okay, so let me just continue my slide. We only have a few more slides left. Then we can basically go for the Q&A, right? Okay, so this is currently available now. So let's see how it actually works, right? So here we actually divide into two, one to go long and one to go short. Okay, let's say so I name it as ET-CFD lah. So we are trading ET, for example.
Yeah.
Okay, so we have a CFD with a 10% margin. All right, so this one, like I said, every product will have a different margin criteria, right? Some 10%, some 20%. If you trade the indices, right, it's actually 5% margin. That means you're actually getting a 20 times leverage if you're trading, let's say, the S&P or the Dow Jones and so on. All right. So let's say the current price is $2, and both of them, one we have a guy here who wants to go long, and the lady here wants to go short. Okay, both of them open the same account with $10,000 each. Okay, and let's say they also want to enter 10,000 shares. Now, I've looked at the trading platform that's provided by CGS-CIMB. You can actually set, the quantity by shares or value. All right. So if it's too lazy to calculate, like, if you want to buy 10,000 ringgit worth of shares, how many shares should I buy? Right. So you can put either one, right? You can put the number of shares, or you can actually put just the value that you want, and then it will just calculate for you automatically. Okay. So let's say I want to buy 10,000 shares. Okay. So buy, right? This guy is going long. Whereas this lady here wants to go short, so he wants to sell 10,000 shares. Okay, so both of them enter into a contract, for example. So the value of the contract, if you want to buy 10,000 shares, is actually 20,000. All right. So if you go to the traditional stock market, if you want to buy 20,000 ringgit worth of shares, you need to have 20,000 ringgit ready to buy those shares. All right. But in this case, because of CFDs, you don't need to fork out at 20,000, and because the margin is only 10%, only required of 10%, you only need 2,000 ringgit. $2,000. Okay, let's just put all $2,000. Okay, $2,000. Okay, so you need $2,000 to actually buy 20,000 worth of shares. Now, on the short side, is the same thing. I'm going to go short. I'm going to open a short contract, and I don't need to also come up with $20,000. I only need to come up 10% of it, which is $2,000. Okay, so let's say both of them buy. Okay, both of them, one of them buy, one of them sell, one of them go long, one of them go short. Both of them open a position. Okay, so remember they have $10,000 each, right? But because you need to have $2,000 to buy that $20,000, so you are using that $2,000 from the $10,000, okay, value that you had earlier into your account. So this one has to be blocked. That means this is already being used. Okay, so you still have another $8,000 where you can buy other shares, other CFDs. Okay, you still can buy the CFDs with the 8,000 left. Okay, so margin use is $2,000. So now the only difference between both of them is one is on a long position. The guy is on a long position. The lady here is in a short position. Okay, so let's say both of them buy on Wednesday. Okay, same time, same day, let's say, right? Both of them probably go to opposite direction. So they bought on Wednesday. Okay, now they decided, okay, they don't want to sell the position, and now it's end of Wednesday. Okay, at the end of Wednesday, for example, at the end of the day, the price went up 10 cents. All right, so the price went up only 10 cents. Okay, you already make $1,000. Okay, remember you have 10,000 shares, right? If you have $2.10, okay, your value is now 21,000. Your cost was 20,000. All right, so you already made $1,000 profit. And remember, you're only using $2,000, right? You're only using $2,000. Okay, so if you make $1,000, that means you've already made 50%, okay, from the margin use. Okay. The price only went up 5% in that day, only went up 5%. But because remember, if it's 10% margin, you get a 10 times leverage, right? So that 5% translate, you multiply by 50, you multiply by 10, it translates to 50%. Okay. So that's by price just going up 5%. But of course, if you're on the wrong side of the direction, okay, you go short and the price went up. Okay, now it's at $2.10. Now you have a $1,000 loss. Okay, that means you are losing 5 or 50% from your margin that you used to actually buy that particular share. All right. And because we hold it overnight, we haven't sold it, then there'll be some financing charges. Okay, remember the overnight financing, right? So I'm using this 4.98% and 3.02% based on the earlier example that I gave. Okay, like Alvin mentioned earlier, the rates currently, the real rates that you're basically paying is now less than 4%. All right, it's less than 4%. So if you do the calculation on that particular day, you're going to be charged $3. All right, $3. If you're on a short position, you're going to be charged with 160. Okay, so immediately the reason why you see on the account value, okay, the number is a little bit odd is because you have to the financing rate will be deducted from your account. All right. Now now end of Wednesday. Now let's go Thursday, right? So at the end of Thursday, okay, end of Thursday, both of them still holding the position. The price now is $2.30. All right, $2.30. So your account is still the same here for the guy. All right. Now you make $3,000 profit, which is 150%. Okay, remember your margin use is only $2,000, right? But now you're already making $3,000. Okay, so it's 150% from the margin that you actually put in. And then you get, of course, if you still hold your position at the end of the day, you'll be charged $3.20 for finance. So you deduct it again from your account. Okay, so it'd be it's like being charged $3 every day, yeah. For the short side, okay, you lose $3,000 because you are against the price, right? So at $2.30, that means you are down $3,000, and you'll be charged another $1.45 for financing. Okay. Now, what happens if the price continue to go up, right? Okay, on Friday. So for Friday, this guy decided to close his long position. Okay, with a 40 cents profit. Okay, 40 cents profit, which translates to $4,000 lah, right? $4,000 because 40 cents you multiply by 10,000 shares. Say the current value is 24,000, but if you still remember, your cost of purchasing that share was 20,000, so you make $4,000. Okay, so you actually make a profit of 200% from the margin that you put in. The margin was $2,000, right? So you make 200%, and of course, if you close your position, everything, your margins and or your profits will be added back to your account, and now you have supposed to have $14,000, right? Because you make $4,000, but because you remember you minus off your financing cost, some of them, right, which is about $6 over. So that's why you get 13,993.75. Okay, whereas this lady's case still haven't closed the position, it still have open position. That means now he still have an open position of a $4,000 loss. Okay, now notice this, right? Because the margin is calculated on a daily basis, you only put in a margin of $2,000, right? You only put in a margin of $2,000, but now because you already have a 4,000 loss, you need to add up that $2,000 into your margin. Okay, we call it a margin call, a margin top up, right? And if you, of course, your account still have money, remember your account still have $6,000, so that $2,000 will be deducted immediately from your account value. So that's why you only have $6,000 left here, right? Because you use another $2,000 to fund that particular position that is still open. Okay. Now imagine if you don't have money in your account value, what's going to happen is you really need to go and bank in and put in more money into your account, okay, to make sure that you have that margin, right, required. If not, the broker will have the right to actually force sell your position. Okay, and you have to take the loss, even though you can't hold. Okay. So now this lady here at the end of Friday, okay, at the end of Friday, and the price keep on increasing some more, now to 50 cents, 250. So he's losing $5,000 now. Okay. And because let's say this lady do not want to lose money, he said, never mind, I hold, I'll see what happens on Monday, right? So now you're going to be charged with another, if you hold it on Friday, and remember, if you hold it on Friday, you'll be charged 3 days, right, instead of 1 day, okay, because it includes the Saturday and Sunday as well. So if you look at the calculation here, it's 3 over 360, not 1. All right, it's calculated 3 days if you hold it overnight on Friday. Okay, so you'll be charged $3.80 instead of the normal $1 plus. Okay. So now on Monday, the price went up to 260, and what this lady decided, I think I better get out lah. Okay, I better get out. So he's basically going to lose $6,000. All right, so $6,000 is like how many percent? You remember initially you only put $2,000, right? So you lose $6,000. That means you actually lost three times or 300%. Okay, 300%. Okay, but the price only moved 60 cents. Okay, the price only moved 30%. All right, but you multiply 30% by 10 times, that's why you get 300%. Okay, so you lose $6,000 and you close your position, all will be added back to your account. Your value now from $10,000 becomes only supposedly $4,000, but you minus off the financing fee, it takes about $7 from here. You only have left with 3,993. Okay, so that's how it looks like, right? Now, if you think that this price that I give here is is quite volatile, okay, maybe after this I'll show you example of stocks like Tesla, stocks like some of the US stocks, they can even move like 10 to 15% a day. All right, so if you're trading Hong Kong shares, some of the shares are even more volatile. Okay. So there are possibilities that price can actually move this much. Yeah. Okay, so that's how it works. And guys, if you have any questions, okay, you can ask those questions. But I'm just going to go through a little bit with you guys about if you want to start CFD. There's actually a question here that asks, looks like CFD is not for a newbie. Okay. Yeah, it's
I don't know. I mean, I guess newbie depends on if you're a newbie, then you start off with a lot less money, right? That's my guess, and it's really about learning learning how to do it. Apart from just buying stocks, I guess if when you're a newbie in stocks, maybe you start with $2,000 first. I don't know, $4,000. I'm not sure, right? To kind of, I think without you even think about making money, kind of get to understand how it works. Because I think, well, for me personally, for value investors, it's a long-term thing, and it's quite attractive, lah. These CFDs, right? Because you can kind of still do it without having a lot of capital, and you get access to other markets as well. So it's kind of like a once you get a hang of it, then only you might want to more, when you're more comfortable, then you might want to decide to put more money in, right?
Yeah. In fact, for trading CFDs in Malaysia, you one of the requirements is actually you need to be a sophisticated investor, lah. Right. So the requirement of sophisticated investor is the same requirement that that you need to actually buy like leap stocks, for example, right, where you need to have a net asset of $3 million, 3 million ringgit. Is it correct, Alvin?
Yeah. Excluding your primary residence. But I think right now you can sign you can sign a declaration or watch a video online to kind of to be able to pass off as a CFD. Actually, at the end of the day, I think they want you to understand how it works first, lah.
Yeah. So you can actually do a self-declaration if if you want to. I mean, you have to declare yourself as a sophisticated investor, like if you want to. Right. Yeah. And like Alvin said, you probably need to go through a series of training. Maybe we can use this training as one of the criteria, right?
Yeah.
Okay. So
I think, actually, like what Daniel was saying, I agree. It's actually less complicated than warrants because there's no exercise price, there's no expiry date, and then there is no ratios to calculate as well. Don't forget, warrants also got ratios to calculate because not all of them are 1-to-1, right? And it's essentially like buying a stock, but you think of it's like how when you buy property, you buy your own home. It's the same. It's really just in a way leverage. But I think the beauty of this leverage is that I think to answer Ku Tian Ming, right? He's saying that if your open loss exceeds your initial margin, your margin won't increase. Essentially, they'll take it out from your cash balance. So, for example, if you say hypothetically, even if they give you 10x return, 10x margin, right, you don't necessarily have to take the 10x, right? The 10%. You can still put 50% down, right, in your cash balance, right? So that even if it drops by 50%, technically there still won't be a margin call. So it's exactly the same as stocks. But if you're buying good stocks, you don't expect it to drop 90%, right? And I guess that's the whole idea with investing as well, right? So Tianming, so do I still, well, yes, actually now the CMB just launched its product and it's actually licensed by SC. So actually I'm actually quite excited about this new product, because before that, we had all these market maker guys, and I was not very comfortable because they were literally betting against you, right? But this is a straight through one, and it's also local. Of course, it's done with a bank as well. So I think it provides a lot more transparency. So that's something that I would I mean, I already have an account, so when we start this mentoring session, I mean, I'll be testing it out with you guys, myself and Benny as well.
Yeah.
Yeah.
Yeah, this is definitely a good instrument for traders, lah. Right? And like Alvin said, because this was just being introduced, right? It's regulated, is in Malaysia, because most of the time CFDs are not based in Malaysia. That's why we're very hesitant to actually trade the CFD. But now you see, I think we really look forward to using this platform, right? So yeah, we'll let you know how it goes.
Yeah. Okay. I think to answer Lo Chin Yu, right? Okay. I think live quotes. For live quotes, if you want live data, I think for US market, it's $3 and $3 per month. That's what you have to pay for live quotes per month, right? But if you use delayed, it's free. I think it's if you use a live pro version where you get one level depth for US market, NYSE and NASDAQ, it's $26 a month. Okay. So it depends what you're after, right? They call it level 1 and level 2, right? So best to kind of check with the CMB guys as well. Just to answer Lo Chin Yu, yeah.
Yep. All right. Okay, let me just go through with you this. Actually, this is the last slide, right? If you want to start CFD, what you actually need to have now, because CFD is a leverage product. It's best that you know what you are doing, right? Whether you have an investment plan or a trading plan, whether you apply value investing principles or chart analysis or whatever analysis that you have, okay, make sure you know what you're doing. All right, you know when to get in and when to get out. All right, because if give you an example earlier, if you're a lady earlier, if you do not know how to get out, if the market go against you, especially, and if you do not know how to even manage your money well, it can be very, very detrimental, right? You can basically lose everything in a matter of days. All right. So that's one. But I think the most important part in CFD trading is how you manage your money, right? Like Abby mentioned earlier, I can put $10,000. I can just buy one counter and use all that $10,000 with a 10% margin. I can buy $100,000 worth of stocks, right? $100,000. But instead of buying $100,000, what if I only buy $10,000 worth of stocks, right? And I only require $1,000 as a margin. So you trade smaller, then of course your risk will be smaller as well. Yeah. So that's very important. And of course, this is something that is also going to be shared during the 6 mentorship sessions that we're going to have for CFD trading. All right. So importantly is you have to basically invest or trade according to what you can afford and do not over trade, right? People tend to over trade because once you start to make money, you get so happy and then you just go silent, right? And that's one thing that you do not want to do in CFDs. Okay. And of course, later on, once you have the plan and once you have that money management, that you know how much you trade every time, then you need to have the discipline also. All right. So it's like basically it's like trading if you are trading, right? And of course, you also have to be aware of risks. Okay. Other risks, like there are always news. Okay, live news, events. Like for example, I still remember, I think 2 weeks ago, when our Prime Minister suddenly go and ask and go and seek Agong's audience, right, for declaring an emergency. All right, the stock market reacted, then just suddenly turned. Okay, so these are, of course, events, risks that you have to take note of. All right, And of course elections lah, and then even that news that we got yesterday, the 90% efficacy on the vaccine. All of this, well, of course, you need to be aware of, because any small movement in stock prices is like multiplied many times. Okay, depends on how much leverage you use. Okay, for example, if you use a 20 times leverage, even if the price goes down or goes up 1%, okay, it will affect the price 20%. Okay. So of course there are also overnight risks, right? For example, if you want to hold your position until the next day, okay, between the market close until it opened the next day, anything can happen. All right. So the market can gap up or even gap down. Of course, if it gaps to the direction that you want, you'll be happy lah. Okay, but if it gaps the opposite direction, then you get panicked. All right. So these are some of the risks that we also need to take care of. Okay, so understand. I think once you understand the product, and at first we all think that it's very risky. I thought that futures market was risky until you really got to know how to play with the leverage, right? How to manage your money. And same thing with CFD as well, right? If you know how to manage your money well, and if you know what you're doing, then your risk can be minimized. It's basically just like trading a stock, but here it gives you the flexibility of setting your leverage, okay, by how much you want to trade. Okay, so that's the beauty lah. If you don't want leverage, also can, right? That means if you put $10,000, you just trade $10,000 worth of that particular shares lah, right? Then basically you don't have leverage. Okay, leverage is only when you want to trade more than whatever that you have deposited in. All right. So the reason why I mentioned this is because this is what we're also going to be sharing moving forward. Okay, in our future sessions, we're going to go and focus on all these techniques. Whether it's for there will be some price chart analysis, and Alvin will also be sharing with you guys how to look at the fundamentals of the stocks or the company, right? Based on value investing principles, and we're also going to talk about money and risk management. All right, so do stay with us lah. Okay.
Yeah. Okay, got one question here, Benny. Do you use FA or TA for CFD?
If you are trading, then TA lah, right?
Yeah.
Especially if you are really on a very high leverage, then you have to get in, get out probably the same day lah. Right? Because there are some volatility. So again, it depends, right? I mean, like Alvin, you also mentioned that you can also use this for investing in the longer term, which actually is possible as well, right?
Yeah, I used this the last time I used it in Singapore. I think it's not trading, so it was like an 18-month to close off my trade. 18 months, almost 1.5 years. I believe my return was 3 times, right, in the 18 months because of that leverage. And I didn't use too much leverage. I probably used about 50% only, right? And all I did was the stock came down and I averaged down and then kind of averaged up and kind of closed my position. So what is interesting is that you control the risk that you want to take. That is actually the most pertinent thing. I think for FA or TA, depending on your personal style, but if I'm going to buy, example, Tesla or Apple or anything, none of my fundamentals or analysis will change at all, right? In fact, if I'm going long, then I just know that my financing cost is now about 4%. And the question is, by the time I close off my position, can I make more than 4%? Right? I think some of you, like I think Darren and Cynthia, came through the class, right? Over the last weekend. Even if it takes me 2 years to close off my position, which means that I have to pay 8%, right? The question is, can you make 8% from the market, right? That's with the right techniques.
Yeah, about 4% for a finance cost is really, really cheap, right?
Yeah.
And it gives you the flexibility to actually manage your leverage, so you have a lot of flexibility for that 4%.
Yeah. Yeah.
Okay. Okay. There's a question here, I think, from YS, who is the financing rate fixed? No, it's not fixed. Right? It's like a base lending rate lah. It's like banks lah, right? They will revise it over time. And I think the last one that we got from CIMB was, is it 3.75% now?
Maybe I share the screen, Benny. What do you think? Let me share.
Sure.
So I can kind of show them. This is actually on their website as well. So if you can kind of see here, like, okay, so I looking at this, this is their commission all in. That's the trading one, and the minimum trade, right? That's a brokerage, but it's actually 3.75. It seems from this document it's fixed, right? It's 3.75 plus the base rate. So in the case for US dollar, if you can see here, US dollars here, the rate is actually based on LIBOR. 1 month LIBOR right now, which is the London Interbank Exchange overnight rates, is actually 0.15. So it's literally 3.75 by 0.15, right? So the question is whether or not you can make. So it's less than 4%, right? So it's pretty much you're paying home loan rates. So if you think about it, if you 4%, right? The question is, it's almost the same concept, right? If you buy and hold over a 10-year period, right? Or whatever period, it's the same. Whether or not that asset price will go up much higher than that interest that you're paying. That's it, right? Of course, unlike your home, where if you live in it, then you don't get rental. But if it's something that pays you a dividend, even a 3% dividend, actually your net is only about 1%, right? And whether or not you can make more than that from that capital gain, on top of that, you have that leverage as well, right? So I think if your target is a 15% CAGR, it's a lot easier to achieve with a product like this, as long as you understand how it works.
Yeah, so it's giving your money additional boost with the 4% rate.
Without taking extra risk, that's the beauty of it. Without taking excessive risk,
Yeah. So I guess now is one of the best times, because this is one of the lowest interest rates of all time, right? Especially in the US markets.
Yep.
So this is a very good opportunity for us to be exposed in the US markets by through the CFD platform. And we look at the commission rates. If I look at this, I think it's still cheaper than buying stocks, right, from Malaysia, buying physical stocks in the US. Still cheaper.
Yeah. So if you want to buy stocks, the brokerage will definitely be cheaper than buying stocks. That's for sure. Except that you have now the only sort of catch here is this, right? So if you pay let's say you buy $1 stock and you pay 10%, right? But you're paying 3.75% plus base rate on the whole 100%, right? So that's the difference. And whatever cash you have in the trust account actually carries no interest, right? So that's really where the banks actually earn the money, lah. So, and I think that's fair play, right? So it's actually quite an old product. CFD is a very, very old product, but it's very new in Malaysia. That's what it is. It's actually a very old product. So used in the right way, over the long term, I think I don't see it any very different from a bank loan. But,
this is cheaper than bank loan. This is almost like you said, it's almost like proper mortgage rates, right?
Yeah, mortgage rates. I mean, it's crazy, right? So yeah.
Okay, let me see whether I can get her question right now. Shanice is asking, if the stock go opposite direction of the CFD, loss 5,000 or some percentage of 100K. I bring it up so I'm not sure about her question. Are you able to get her question?
Okay. So I think if a stock goes opposite direction of the CFD, it's a loss of 5K or some percentage of RM 100K.
Maybe she needs to give us more context, lah.
Yeah, I'm not sure actually. I guess she's saying invest 100K, and then if it's I'm not so sure. Just remember the loss or gain is whatever. Let's say a stock price goes up 10% and your margin is 10%. You just multiply 10% time, add another zero behind. It's 100%. That's all. So 10% you go up 10%, you make 100%. Go down 10%, you lose 100%. Just add zero. That's it. Yeah.
Yeah, so that's why one of the things, this is very important. Your position size is very important, right? Because that's what normally a lot of investors did not take or did not look at, right? You always look at the price, but never look at the quantity that they want to trade, and that's going to determine your risk, lah.
Correct, and that's what actually we spent a lot of time over the last weekend. For those who joined our SPM class, we spent a lot of time on laddering, and that's where we talk about position sizing, right? So this is a very good application of that. Okay, exchange rate. From what I understand, the exchange rate is, if let's say you want to start out with, let's say 10,000 USD, I think they'll take the exchange rate at that point in time, and then only when you want to exchange it out of USD, so you'll settle in USD, it'll stay in USD for as long as you're trading. But the moment you want to, so the exchange rate is as and when you want to exchange it and take out the money lah. Am I right, Benny? Correct.
Yeah, correct.
Yeah,
correct.
Okay.
So once let's say you convert and buy a US shares and you sell those shares and you can actually leave that US dollar. Okay, so as and when, like I've been saying, as and when you want to convert it back to Malaysian ringgit, or even convert to Hong Kong dollar, or even convert to even Singapore dollar, you can do at any time. Right, anytime. When you find the rate is good, then you convert lah.
Yeah.
Okay, let me see if there's any more.
So if you guys want to just open an account, you can just go to CGS CMB. I believe it's free. You know, just click on it and open it. I think don't think it costs you anything. Are we all filled up in our 20 spaces that we wanted, Benny? Do we have more than 20 people already?
Right now we have, because they are still in the process of opening accounts, and it's going to take some time. But we do have. But in case if someone drops out, then we may look for some more lah.
First come, first serve. Okay, so if you guys want to take part in the CFD program, drop us a message on Facebook or something. Because we're doing a program where if you put in 4,000 and you lose, let's say, up to 2,000, then that 2,000 is actually covered, right? It's part of like a learning fee lah, right? So this sponsorship, right? Okay. I think it's a great opportunity to kind of test out the program. I mean, 4,000 ringgit is not a lot of money when you start trading US stocks. But what we're going to do in that mentoring program, we're going to try and use the 4,000 bucks and let's see how many stocks we can buy. And then close it off 6 weeks later. Obviously, it's not going to be representative because 6 weeks is too short for value investing. But, you know, it's just to get you a feel of things, right? Yeah. Oh, there's one more place left. Okay, cool. Can we post a link below so that some of you can sign up? For those of you who are interested.
Yeah. Okay, if you don't have the link, you can just say that you are interested, then we'll get in touch with you lah.
Yeah. Just put PM in the comment section below, and then we'll comment. Hey, Darren, I announced this over the weekend as well, right? You didn't fill out the form. Yeah.
Yeah, Lo Chin Yu, you can just say, just put a PM, then we'll send you.
Yeah, put PM there, then we'll send you the link. We'll do on a first come, first serve basis, okay? So you guys just got to open an account, like I think send in some details and sign up, and that's it. That's all you need to do, right? Yeah, remember to use your lettering background.
all these guys, all these are still fresh from the last weekend's class, right?
Yeah. But those who attended the class, do you guys now see where letters can be applied into this right now? Just curious. Some of you are in the audience, right, who are watching it. Yeah. So we have PM. Yeah. Okay, so we're gonna do on a first come, first serve. Okay, so depends how quickly you can get your documents and all to CIMB to open this account. Okay, that's key, right? So it's really just a 6-week program. It is for fun. I don't think you're gonna make millions from $4,000. Okay, I won't be very realistic. Okay, you might end up losing money in the 6 weeks because 6 weeks is very short term. Okay, but it's just to give you a feel of how it works, and then you build either your long term or your trading portfolio, right?
Yeah, this is the best opportunity to test it, lah.
Yep.
Really, you have $2,000. It's risk free $2,000, and you know what? Whatever profits you make, you get to save it. You get to keep it.
Yeah. It's a great deal, right? Yeah, it's a great deal. You get the limit up to 2,000 of losses. So, any profits you get to keep, it's all yours, right? So maybe a little Christmas bonus for you, right?
Okay, you have Wing Key Sim says I have a CGS Singapore account. Can I join? Okay, one of the criteria is you have actually there are 2 criteria which I forgot to mention, Alvin.
Oh yes. Yes, very important.
There are 2 criteria. Number one, you have to be an equities tracker subscriber or member.
Yes.
Okay, that's you must be because this is sponsored by us and also at CGS CIMB, right? So you have to be a member. So that's priority lah, right? Now, number 2 is you need to be a client of CIMB Futures for CFD account. Okay, so 2 things you need. You need to be a client of CIMB. You need to be a member of ET. Okay. Yeah. So make sure you got that right. So if you are not
anyway, right? That's how you're gonna trade, right?
Yeah. So if you have not opened an account, don't worry. We just have to open an account, right, to participate. And if you have a CGS account in Singapore, if you want to participate this, you still have to open the Malaysian one. All right, you still have to open a Malaysian CFD account. Okay, that's to answer Wenki Sim.
Yep.
Okay, Darren say yes, ladder is going to be a great technique here. So this is a good time to apply it, right?
Yep. So you just got to be a Genius subscriber, active Genius subscriber, and that's it. Right? Either MVIP or subscriber of ET. That's all. That's all we need, right? And we give priority to some of our MVIP clients, okay, our masterclass program clients, because you guys know how to use the ladders, right?
Okay, looks like that's it. Any more questions you can see here? Alicia, keen criteria met. Okay, just say okay. We'll send you the details, Alicia.
Okay, cool. The link is posted here, so maybe I want to just how we're gonna get this on YouTube as well, right? Let me see if it's on YouTube.
I just put it up here. It's bit.ly/etcfd.
Hang on, let me just send it through into bit.ly etcfd. Okay. Oops. etcfd. All right. So there we go. Okay. bit.ly. Yep. All right. So if you guys have that comment, it's basically bit.ly/ETCFD, right? Equity Striker CFD, contract for difference. Member of ET Online Campus. Or how about members from ET Online Campus? No, it's only ET subscribers, right? For ET subscribers. Okay, it's a special thing for ET subscribers, right?
Yeah, because the place is quite limited. We only have 20 participants, right?
Yeah, and literally giving free $2,000, right? So,
well, if this is successful, maybe if this is successful, maybe next year we can get 100 people, lah. Right?
Yeah. Okay.
Hopefully, you guys are doing well. You guys will do well.
Sponsors and see how it goes.
Yeah. Okay, guys. I think that's about it. Thank you so much for joining us tonight. Again, if you need any assistance from us, just PM us. And again, if you are interested in this program, just go to bit.ly/etcfd. Okay. And for you guys who have just joined us today, thank you so much. I hope that this will give you an introduction to CFD, and we do hope to see you again in the other sessions. All right.
Yeah.
Okay. So thank you.
Mandarin session, right?
Tomorrow, yes, tomorrow we have a Mandarin session going on, and of course, on as usual, a future-proof Thursday, where anything futuristic is on Thursday. So do join us on Thursday as well. So tomorrow, the Mandarin session, I think they're going to talk about the effects of the US presidential election and the budget as well. Okay, so do join us tomorrow on our Equity Striker Mandarin page. All right.
Yeah.
Okay, so thank you so much again, once again, guys, for joining us, and I'll see you again. Have a good week and good night.
Thank you again. Bye-bye. Good night.